we give you 10 grand now instead of waiting way out 10 years. We'll give you an extra 10 this year, but you got to extend us a year. Done this several times with owner financing people. They go, yeah, give me a little principal now. They like the cash flow and we'll extend your term. Little techniques to pull more out of a deal. Paul, do you have the details on your deal so you can get back to that guy? Because you kind of owe him this, right? We got to get back to him. Yep. Did Zach? Well, walk me through. Did Zach? How far did he get on the call?
I called him a couple of times. Zach followed up yesterday. He said the property with 105 acres. He's going to break it up into 3 parcels.
You guys, this is in your book. Sorry. So let's use this for the deal structure so that we're on the same page. Okay.
He was doing the house and the barn for.
So he's keeping the rest. We don't have to mess with that.
At this point, yeah.
Great.
So it's stick with the own buildings if they're on.
And Zach was going what route with this? Just so I get my brain around it.
The owner financing.
Sweet.
916 purchase price.
And this was what type of source?
This was I think this was wasn't expired. I got this from my Paydays.
Sure. That's all right. So maybe expired.
It was expired, even though the guy keeps signing it. So
it's like he keeps re-out, right? What was he on for? What's he on now, Puff?
He was on for 121. He's on for 916. Now
916. Okay, he's free and clear, I assume?
Yes.
Okay. Did you and Zach, how did you leave with the guy as far as term and price and monthly?
We didn't do monthly. We talked 10-year term.
10, and he was good with that?
Yep.
Sweet. Okay. 10 years. Let me comment on this, you guys. So for the exit, options here. Option one, you start the same all the time with the coaches and Nick. You get the people qualified. The screening comes back and says, okay, Richard's your buyer, and Richard will be qualified in 18 to 24 or 24 to 36 months. That's where most buyers come back, by the way. Now, whether you push that with your thumb on the pulse, in this case, you wouldn't need to because you have 10 years to let them do what they want to do. When you don't push them, they usually take the time. When you hold them accountable, they'll cash out when they need to cash out. So he has the option of just letting that be and giving them a term of, 2 or 3 years at first, and tell them if they perform that you are open to extending. You want to keep control over them. And so if they screw up and you only have a 2-year term, you have 8 years left to do whatever you want with the property. You don't ever, because you have a 10-year term, give the buyer a 9-year term, for example. You're asking for trouble there. And you're also locking that price in. Okay, so just thoughts for you. Could he also, if he buys this owner financing, could he also turn around, put a tenant buyer in for a couple of years, give them some hoops to jump through, like, hey, you got to stay current. Hey, you got to get your deposit up to 20 or 25% over time, and then I will want to finance you, Mr. and Mrs. Buyer. Could he also do that? Because you could do rent-to-own for 2 years, then I want to finance him for 5 more years and stay in this deal. You tracking with me? So I should know there's options. That's all, if nothing else. Okay, let's do numbers then.
So
you stopped here? Yep.
So the debt is one.
There's no debt. It's free and clear. Yep. I'm glad you're asking. So if you fill out the sheet, it's free and clear.
Equity.
Equity is the full 916 the owner has right now, if that's what we're agreeing on. And quite frankly, if he's getting 10 years, and if we get principal pay down or even principal pay down monthly for a few of those years, he doesn't care about the price. This 916 is more than fine.
Source.
He thinks expired. The guy keeps listening, but he thinks expired.
When you say type of deal.
That's type of deal will be owner financing. Yep. Owner finance. Okay. So Paul, is that kind of where you guys stopped and now you owe him some options?
Yes. That's where we're starting. So.
Okay. How adamant was he for the 10?
Zach was talking to him. He had mentioned that he bought his property, his sort of land with this, and he did a 10-year thing. So that's where the number was. So he was okay with.
Okay. You guys, in about, if you can hold it, in about 10 minutes, we'll take a break. Okay. I should have said that so I can give you guys something on. All right. Why I'm asking is we can either use the 10 for offer number 1. and go down to 7, make it a little less desirable for him, or we can go up to 12 or 13 and make it more desirable, right?
Yes.
So let's go with the 10-year first basic. Can you guys, who has a calculator? Paul, do you know roughly what the rent is in this area?
Counts are tough for that site.
Ballpark, you think?
I don't know. I don't know. So,
All right, let's do this. Who can tell me with today's current rates? This is Connecticut. That's probably a jumbo. What's the mortgage going to be?
quick mass.
Southbrook, Mass?
That's this one.
Okay, so it's definitely a jumbo then. What are rates going for a jumbo if somebody was to take out $800,000? What's the payment and rate? I'm just getting familiar, so you guys know my brain is, with what are rents and what's a buyer going to look at, like if they have to buy this, where's their brain? And I want to see where those two numbers lie.
800 at 7% for
Ballpark, yeah.
5291.
So about 5291. This is not on the deal structure sheet, guys. I'm just getting to the points where a buyer would think.
Principal interest. Yep.
Yeah, principal and interest would be roughly what a buyer would have in their head if they were going to finance $800K. I just want to get kind of a gauge to get you guys thinking what they'd be thinking. So would rents be lower or higher than that, Paul, in that area?
Rents would be lower. It looks like 22, it was 25. I still have a cell bomb.
I was thinking the 3s, yeah.
You know,
So, all right. So this is pretty common, you guys, with the rates the way they are. Your rent to own price is going to be lower than the current mortgage rates. That's where we are right now with the economy, right? So it's advantageous for a buyer, but they got to be qualified at the beginning to make sure this is not going to set them up to fail at the end, right? All right. This is just for our knowledge to kind of know. And the rent comps, roughly, we'll say 35 for $1 million house. I think so.
probably have.
I think conservatively. All right. So what would Paul want to pay the seller monthly principal payments against the 916? And by the way, should Paul go up a little bit on the 916 if we're getting a full 10 years? Even if it's a teeny bit.
Making more track
I think a touch,
there.
because I'm saying a touch and it's never a round number. So my suggestion, now you guys can go back to the deal structure sheet. My suggestion is a purchase price on this option of say like 923,700. I'm just coming up with a non-round number for the seller to know that you well thought this out and it's a specific metric.
Fair.
Okay. So that's your offer for 10 years. Now, if you're getting rent of 3,500, you're going to add taxes and the buyer. But what do you think we should go to the seller at? I know in my head where I usually am for $1 million house, but what do you guys think?
Right. 2,500.
I'm usually around 25. We said that. Yeah, I'm usually. I try it at $1 million house. We did one at the Cape on the water. We did 2,500 a month. That's all. Like, it's usually where my head is, and you have room to go up because of this. But that's where I start. So let's start there, Paul. So the monthly, when you write this up for him, I'm happy to look at it, Slack, and tweak it. But you should be good after this.
Yep.
The monthly, let's go 25, 22 monthly principal. On your deal structure sheet, you're down to monthly payment of 25.22. Where did the 9.23 come from? I increased the sales price a teeny bit to entice the owner because it's free and clear and we have 10 years. And there's no set thing, James. I could have said 9.19. I'm just trying to give a little buffer. Look at how much money is that?
And then 7 grand.
$7,000. 3 months, he ate that up. So it's not a big deal. And he's not paying for it, though.
I just wanted to buy. At least I got there.
Wild ass guess.
Okay.
Without a lot of zeros.
Got it.
Keep it specific. Okay, so we got the monthly payment to the seller on your deal structure sheet. We have the payment from the buyer, which is going to be the $3,500. It might be higher, but we're going to go conservative. What's the difference there, you guys?
$1,000.
970. It's 978. It's payday 2. Let's stick with the sales and Paul can get this out to him. monthly to him, sales price, and a 10-year term. Okay?
In this particular case, because it's owner financing, you as the buyer are going to be paying the taxes and the insurance on it.
But you're passing the taxes on to the buyer.
Right. So normally on another deal, your payday 2 would have that on top of it. So that would be in your pocket. If it was PITI, it goes PITI alone. But in this case, because it's being paid out, it's a wash.
Let me try to give you the end result of that. So out of Paul's pocket, because the taxes are passing through, he's going to come out of pocket for insurance on this spread. What do you think insurance will be? 200?
Maybe up to 300.
Let's use 200 for insurance. So his net payday 2 is 770. Follow me, guys? Payday 2, 770.
All right, insurance is only $2,400 a year on $1 million property.
I pay 21 or 24 for my house. It's assessed at like 1.8.
We have to go in them.
Yeah, I think that's obnoxious too. I think it'll be higher.
Florida is going to be higher.
Florida's high and
$1,000 a year.
yeah, that is don't have it. Florida, you get soaked. Connecticut's obnoxious with taxes. Insurance, I don't think so. But around here,
It's not all masses, so.
I mean, I grew up in Mass. That's about right.
Nothing. Sorry, I didn't mean to derail it.
No, you shouldn't, because in Florida, they're wonky deals.
Yeah. Georgia, it's $500.
$500 a month, about. Okay, so Paul, on your end, then we'll come back to the 3 paydays, guys, and we'll use this one. But on Paul's end for the seller, here's what he's going with. That's option 1. You good with that?
Yep.
Okay.
Interject, just
Yeah. Well, no, we're doing option 2. And there's no set thing.
going back to Brad's point, the insurance, and in this particular case, you may be coming out of pocket payday 2, but if you look at your payday 1 on this and your payday 3 with 25,
Payday 3 is huge.
yeah, it's
$30 grand a year.
$1 payday, 2,500 going towards principal. That's a lot.
Yeah, even if Paul broke even on 2, I don't think he will. But even if he did,
Yep.
the deal won't matter. The principal paid on $30 grand a year, and you have to win 5 years, right? If you get nothing else out of this, then he will. He'll get payday 1. Okay, so that's option 1. Option 2, Paul has two choices. I'll just do what I probably would do. He can either go down to 7 years, but keep this the higher price because he wants the higher term. You just incentivize what you want. Or he can go up to 12 years and go a little higher in price. So I honestly don't care. You heard the call. Which way do you want to go, 7 or 12?
Probably 7.
And I'm thinking, yeah, without milking them. Okay, so, all right. If we're using 923 as the base and we're taking off 3 years, there's no set thing, but I typically, if I'm going up or down, I use a calculation of 1 to 3 months of principal, up or down on the price. So if we're going down in term, we're going to minus anywhere between 3 and 9 months, roughly, of what would be equivalent to these principal payments every month. So we're going to lower the price by anywhere between 75, 120 grand. You guys tracking on me on that logic?
Go over that again.
Yeah. So if I'm going to decrease the term from 10 years to 7 years, technically I'm getting less principal pay down.
Mm-hmm.
So I'm going to decrease the price by 1 to 3 months per year I change the term. Or if I went up in term to 13 years, I don't mind going up in price 1 to 3 months of principal per year. I'm extending it. That makes sense? The way it better?
So in this case, like 5-ish grand a year. It's the middle.
2 months? Yep, exactly. No said thing, but yes. So we can even come back to his price of 916 if you want to keep that at the 7 year. You want to do that?
Yeah.
That's that thing, guys.
You still got that number to say.
Yeah. And because he told you 10, it's not like you're trying to milk it and go, oh, I went up, but I also have 13 years. He said he told you 10. and you're still going up when you're giving them this out. But now we're gonna make the monthly a little less. And again, no set thing. I'd probably go 100 something bucks ballpark. You could go 25, 24, 23. I'd probably go 23. I don't know, it doesn't matter, 80 per month to the seller, principal only.
Why would you go down?
I'm trying to incentivize this in every way.
So he said,
And through his payday too.
960 and 10 year.
Yep.
Right? So he's good with those numbers?
I wasn't in this room, but that's what I'm hearing. Yep.
You just go with the 10 years and the price. I mean, it's
Oh, they didn't talk monthly. Sorry. They just did the price and 10 years. Yep.
You think he's in his head amortizing that 10-year pay down for 916 divided by 101?
He could also be at interest in his head. We don't know till this next email goes out. And his email should say something on the lines. Hey, what's the guy's name? Paul. Hey, Paul. Based on our chat yesterday, here are a couple ideas. I always say this in every call. I want to get back with you. You probably heard the call yesterday. I said this to the guy. I want to get back with you, and you can say, hey, I like this, I don't like this, and we'll try to come to a win-win. So that's not, I'm not looking for a yes or no yet from this first email. I'm looking for I like this. I don't like this so much. And then you massage it a little bit. So much room in these to play. So 916, 2380 a month. We'll calculate the paydays based on this one. I just want to give you guys an option. And then it'll be 7-year, Paul.
Yep.
So I would send that to him today, ideally, so we can maybe be talking to him this afternoon or tomorrow, based on your call. This is ideal with the boot camps, guys, where we do the call. Did you already see this house?
No.
Okay, so did you guys book that?
No, we could just, Zach wanted to
Sure.
Adam and see.
Oh, before you even waste time?
He wanted possibly some money down, but we did talk about money down yesterday.
Okay. So you just act like it didn't come up, which you do all the time. Incentives, it doesn't come up again,
Yeah.
which is cool. Okay. Are we good with the theory of the 2 offers he'll make, and then we'll do the 3 paydays? So you guys can see the power of the principal? Yeah? All right. Let's get rid of the mess. And if you think of it as I'm going, please yell anything else that comes up. Let's now just go to Paul's side of the equation and talk about the paydays.
Real quick on that 7-year, the buyer is still paying that 35 though, right?
Yeah. We would change the buyer side. Market will tell us, but yes. So 3 paydays. So this is for your deal structure sheet. Payday 1. If I had $1 million house, whether it's up front or over time, I'm not taking less than 20 because I want to get them in a really good spot to get a loan. Now, it likely won't be up front. It likely, let's go with half and half. But so we're going to mark this up. Sorry, I didn't do price. How long ago was he on for 1-1? Because the public will see that. How long ago was he on for that? Like last year?
Yeah. It's still 6 months ago.
Okay. Then I'd probably go at either $1,099,000 or 1-1. I'd be in that range. Just so we can do math easier here, though, let's do round 1-1. And every time we do this, the question is, well, how can you get that if they didn't get it? There's been stuff in the market for 2 years that we then sell right away. Time-wise, it came up yesterday. I tell a seller anywhere between 5 and 120 days is typical. I will tell you if we're having trouble with the price at about month 2, and we might have to readjust things. I tell them right up front. So when you call them, it's not oh my God, Rick told you yesterday he did this. And the gentleman said, okay, lower it. And that was a sub-2 deal, right?
No, it was another finance.
So the financing, same as this. So you just manage your expectations. Look, I think this is good. I think I got it all worked out. We've been doing this a while. But I'll be the first to tell you after 60 days that I'm hearing crickets and we got to adjust something because you don't want to let this thing sit because it's contingent upon a buyer. So you sell for 1-1. Payday 1 then is, let's use round numbers again because it's be 210, but let's just say $200,000. You're likely going to get that in 3 stages or 2. Let's go with 3 to be conservative. So they come in. Would you let them in for $33,000 in that $1 million house if they had a very solid plan? Not 33. What's the 66? Sorry, a third. Would you let them in for $66,000 if they had a solid plan for the other 2 payments? Like, I know I'm getting this, or I know I'm getting this tax refund, or whatever. Yeah. you guys heard the story. I had a Western Mass, a state trooper, screwed up his credit, and he knew he was getting retroactive sergeant pay. It was like a set thing. He gave me the notice and everything. So he said, I'll commit this much every time I get that raise, that sergeant pay. So you stage that over time. And sometimes you luck out and get it all up front. So payday 1 is 200. Payday 2 then we said was over here, right? You guys follow that? Payday 2?
Yep.
Mm-hmm. Now, let's be conservative. Paul has a lot of options here. He could stretch this thing to 10 years with the buyer. He could cash it out in 3. He could. What do you want to use for our projections here? I want to be conservative. Do you want to use 3 years only? 4 years? 4. Okay, so what's 778 times 48? Somebody.
37,344.
Say it again, Laura.
37,344.
Can you guys on Zoom see this pretty much?
All except the very right. Like,
Rick, can you just a little bit?
Yeah.
They don't need to see. We need to see the far right.
Yeah, they can. It's all the way on the far right.
Yeah, that's right.
Yeah,
Me up.
perfect.
But
that's good right there.
okay.
Over that. Yeah, that's fine.
Every now and then he's just gonna smile at you.
That's fine.
All right. So payday 1, payday 2, payday 3 is where the magic is. So what's 2522 times 48?
121,056.
Okay, so we have principal pay down, right? As part of the payday 3. As part of the payday 3, we have to minus the down payment. We already got it. That's 200 grand. And we have to add the markup. What was the markup here? What's 1.1 minus 9237?
176.3.
1763. This is markup. 1763, Brett?
Yeah.
Okay. Someone tell me what that is. 121,056 minus 200 plus 176,300. And then I'll stop to make sure you guys get that because this is where the confusion comes in. Usually.
97,356. 97,356.
Okay, remember I gave you yesterday the formula to get 6 figures out of an owner financing deal?
Yeah.
This fit that criteria. We're slightly below 3 grand. Not even. Because this house is more than 200 grand, right? Remember that was the formula. This house is 4 years, right? And this house is a payment of $1 grand or more to the seller as principal. That was the formula. And we're just under it. Well, is payday 2 in there? 3. That's just payday 3. Sorry, we're above it then. So good catch, Brad.
Get those
So,
3
man.
days.
All right, so what's 237,344 plus 97,356? We're way over it. That was surprising.
3347.
3,347.
Yep.
Okay, guys, a third of $1 million on a 1-1 house. This is what blows people's minds primarily because of the principal pay down. We didn't mark it up much.
Now, do you like paying that insurance every month?
No, it's spot on. Would you mind if you went negative every month if you could afford it?
Yeah, you can take it out of your payday 1.
Take out your payday 1. Now, what would you do on $1 million house? Let me give you some other nuances in case you have questions, you guys. What would you do on $1 million house to start this deal properly? You would take whatever your percentage was in the payday 1 split, in my opinion, and put half in a bank. So you don't stress if they have a life event and one passes away and one gets arrested for marijuana, like happened to Mike. You just go, okay, I'll resell it. I'll come out even better, but I have that money in the bank. I got 100 grand or whatever it is for you split in the bank. That's what you would do. And I'll tell all you guys on the payday 2s, we set up separate accounts. So the payday 2 for us, we called it our lease account. It's for spreads, and we only put the spreads in there, and we didn't touch them. So there were months where, with all those properties we had, there's 28 to 32 grand a month in spreads coming in every month. So you leave it. So when you have a rainy day or a headache, because they happen, you got it. The other thing you're going to want to do is we'll talk about this right before lunch, maybe if I can squeeze it in. you're going to want to make sure you have the business credit set up for this reason too. Not sure where to get started? Go to smartrealestatecoach.com/get going for free books, strategy calls, and a whole bunch more. We're going to help you get going the wicked smart way. We've been after this for over a decade doing exactly that. Is this clear before we take a break? I said I would take it 15 minutes ago. Are we good here? I'm going to leave it up, but I just want to make sure everybody understands the flow here. Because as usual, it's clear in my brain, but it's probably not crystal clear always for you.
So the seller's benefiting from the 25-22 per month.
Seller gets a 25-22 per month, gets a premium because he's not selling it even at this number now. And he's kicking the can down the road and spreading out his capital gains. He's probably going to be in a different tax bracket then. I don't know. Right? So there's a lot of other benefits for the seller here. Well, Paul gets to depreciate this house, and this number could probably creep up to $500,000 if he ends up financing that buyer and become the bank too. 3 Paydays plus a bank.
Yep.
Super cool. Because they'll charge him interest, probably better than they can ever get at a bank. So they stay in the deal. They don't refinance him because he has zero interest. Right? There's all kinds of tweaks here that can be done. This is just bare bones.
Yep, I had 2 of my deals were about one actually $199.9 was the price that the buyer walked into it for, and those were originally slated as 6-figure deals. So how do you make 6 figures on a property that's $200,000?
Yeah, we in Auburn, Mass, one of our first owner financings, we bought for $183.9, and the profit was somewhere between $124 and $136 in 4 years. We extended it in 6 years. Let me give you a technique, and then we'll go to break. So, Rick mentioned earlier converting a sandwich to a sub 2. Those are fun. We'll talk about that later. On an owner financing deal like this, can Paul talk to this guy in any year technically, but in year maybe 6 or 7, he's got all this money coming from other deals. We do this a lot, and we say, hey, how about if we extend this to 11 years, and we give you, pick a number. I gave the guy $6,000 on a $200,000 house. We give you $10,000 towards your principal. It's not a fee. We give you $10,000 now instead of waiting way out 10 years. We'll give you an extra 10 this year, but you got to extend this a year. Done this several times with owner financing people. They go, yeah, give me a little principal now. They like the cash flow, and we'll extend your term. It's just little techniques to pull more out of a deal. Along that, there's a lot of these little